Hi, my name's Harrison Schiffbauer, and I'm a licensed mortgage loan originator, or loan officer for short. And today I want to talk about points and buy downs. Now, in another video, we were talking about how there are lender credits and even costs to get certain rates. Let's elaborate on that. Now, each rate that you can get from your lender or from your broker has a cost that is associated with it, and these do tend to fluctuate with the mortgage bond market. Just like the Dow Jones or even the S&P 500, mortgage rates really can fluctuate depending on what's going on with the economy. A great example of this is back in November of 2021, the Feds had announced that they were going to go ahead and taper back on buying the mortgage-backed securities, and they were going to start raising interest rates in 2022. Because of this, the market reacted negatively. We've actually seen over the last few months a whole point increase in interest rates. Because rates are fluctuating, some lenders do have better costs associated with those rates. But my job as a broker or as your loan officer is to shop around and to find the best deal for you. So, with this in place, let's go ahead and let's just get right to it. Let's talk points and buy down. Let's first understand the relationship between your points and your interest rates. Points are going to allow you to buy down on your interest rate, meaning you're going to pay less interest, but you're going to pay more up front to get it. Now, for example, when I'm doing a purchase loan, I'm leaning more towards a par rate. A par rate is where there are no costs or lender credits involved. This allows you to get a good interest rate for no cost, allowing you to get in the home easier. Now, don't mistake a no cost interest rate as there are no closing costs. You still have title fees, you still have origination, and you still have your escrows. You just don't have points. But again, if I'm doing a rate in term or even a cash out, I'm going to look at rates that have a little bit of a buy down or a couple points. So that way I can see how much it's going to save you in the long run. This is why questions like how long do you intend to stay in your home are so important. If you're going to be in the home forever, we're going to want to take a lower rate because it's going to save you the most money over the life of the loan. But if you're only going to be in it for a few years, we're going to look at a rate that's going to give you a lender credit, that hard cash from the lender to cover your costs, so that way you're not losing equity. Now, what do I mean by this? We can really charge you anywhere from 0 to 2% of your loan amount when it comes to points. The reason why I like to stay at the 2% mark is because the VA has a hard cap on 2%, but there's also something called QM issues that we can run into if we're charging you too much in points on other loans like FHA and conventional. In a previous video, we talked about how if we take a higher interest rate, the lender is going to give us cold hard cash and they're going to go ahead and cover some of the costs for you. Now, when I say cold hard cash, it's not actual cash in your pocket. It's making it so the loan is cheaper for you, so that way you don't have to put as much down on the table. Depending on the market and how much a lender is going to be giving in a credit, there are times that you're able to get a credit that covers all of the costs of the loan, making it a no cost refinance where you just straight save money and add nothing to your loan. Now, mind you, lenders are more than happy to cover costs for you if you're willing to take the higher interest rate because they know that they're going to make more money off of you in the interest of the loan than what they're spending to get you on that rate. Look, I know we've talked a lot about points and buy downs, and this is really only scratching the surface. So send me an email and we'll talk about how these things will affect your loan directly, and I'll find a solution for you.